Good day, gentlemen. Welcome back to Introduction to Financial Accounting 1. In this lecture, we're going to look at Chapter 5 of our course, which talks about accounting for merchandising operations. And as always, we're going to take a quick look at the study objectives before we begin our lecture. So the topics we're going to cover in today's lecture, we're going to start by identifying the differences between service and merchandising companies. And then we're going to move on to explain the recording of purchases under perpetual inventory system. So first we want to understand what it's a perpetual inventory system, and then we're going to look at how we can record our purchasing transactions under this system. Third, we're going to explain the recording of sales revenues under a perpetual inventory system, and then explain the steps in the accounting cycle for a merchandising company, and distinguish between a multiple step and a single step income statement. And finally, we're going to try and explain the computation and importance of gross profits. So let us begin. So in this chapter, we focus on merchandising operations. Now, when we talk about merchandising companies, we need to understand that merchandising companies are the companies that focus on buying and selling the goods. So retailers, wholesalers, these companies that their primary source of revenue is coming from their activity of purchasing some products and then reselling those products to their customers. So in the case of a retailer specifically, they buy the goods from wholesalers and then they resell those products to the consumers. Examples of that would be Benda Hypermarket, for example, Lulu, clothing shops, Walmart in the United States, for an instance. So all of these are called retailers. Also, we have what is called wholesalers, and these companies usually act as the suppliers for the retailers. So they buy the goods and then sell them to not to the end customer, but to the retailer who's ultimately going to sell these products individually to customers. Now, how does the income statement of a retailing or a merchandising company differs from service providers? We looked at income statements in chapter 1, if you guys remember, and in that chapter we talked about how income statement is created around the basic formula that net income equals revenues minus cost of minus expenses, excuse me. Now for merchandising operations, we want to create a more detailed income statement. So what we do is we begin with the sales revenue and then we take out the cost of goods sold. That would give us what we call gross profit. And then from the gross profit, we expand a little and start taking out our different operating expenses, and that at the end is going to give us the net income of the company. So the new concept we have here is the step in the middle, which is the cost of goods sold, and the cost of goods sold is defined as the cost of the merchandise that were sold during that specific financial period. So we kind of exclude this specific type of expense from the other operating expenses, and we report it individually and deduct it from the sales revenue so we can come to the amount of gross profits. Now let's talk a little about the operating cycle of different kinds of companies. So when we talk about service companies, their operating cycle is typically shorter than that of a merchandising company. Because of the service company, all they do is perform the service, recognize the revenue on their records through the use of accounts receivable account, and then collect the cash, and that would be a complete operating cycle for a service company. Whereas for the merchandising company, they first begin with buying the inventory of course, the inventories being the products that they buy and sell. They merchandise the inventory and then sell them to their customers, whether their customer is a retailer or another smaller business. Then they recognize that revenue through the use of accounts receivable on their records, and after that they collect the cash, and that would be a completed operating cycle. So the operating cycle of a merchandising company ordinarily is longer than that of a service company. As I have mentioned in the introduction of this lecture, uh, different merchandising companies use uh, different inventory systems. Either they use perpetual inventory system or a periodic inventory system to account for their inventory. In our lecture here, we're going to focus on the perpetual inventory system. We're going to try to understand how it works and how we can record transactions under this system. Under the perpetual inventory system, the company maintains a detailed record of the cost of each inventory purchase and sale. So unlike the periodic inventory system in that regard. It Under perpetual system, the company is also records continuously show inventory that should be on hand. So at any point in time, you could uh, find out exactly how much inventory uh, is actually held in the organization. And finally, also unlike periodic inventory system, under the perpetual inventory system, the company determines the cost of goods sold each time a sale occurs. And you're going to notice that in our recording procedure, where we always, uh, with every sale transaction, we recognize the cost of goods sold and we record that cost in our general journal. On the other hand, companies that use the periodic inventory system, they do not keep detailed records of the goods on hand, and the cost of goods sold determined by count at the end of the accounting period. نسميها عملية الجرد. So they make a stock count at the end of the accounting period, and only then they can figure out how much goods, or how much is their cost of goods sold and how much stock they actually have on hand. And the calculation of cost of goods sold is carried out as follows. You have your beginning inventory and you add all your purchases for that financial period. You end up with the goods available for sale. And from that goods available for sale, you subtract the ending inventory, and that calculation will give us the cost of goods sold during that specific financial period. There's also a few more additional considerations that your book provides about the perpetual inventory system. Is that, first of all, traditionally the perpetual system is used for merchandising with high unit values. And second, it provides a better control over the inventory since you're tracking your inventory with every sale transaction. And finally, it requires additional clerical work and additional cost to maintain the inventory records, which you're gonna also notice in our recording procedure next. Now let's look at how we can record purchases under the perpetual inventory system. First of all, the purchases can be made using cash or credit. So just like when we were talking about services, and normally it's recorded when the goods are actually received. And finally, the purchase invoice, similar to what you see here in the illustration 5-5 in front of you, should support each credit sale especially. And then if we move on to the following slide, you're going to see how we can actually use this purchase invoice as a source document to record our purchase transaction. In this illustration, we're going to focus on Souk Stereo. We're going to pretend that we are the accountants for this company, and we're going to record this purchase transaction for them. And based on the purchase invoice that is provided to you in the illustration. Now, as you can see in the invoice, we purchased some products from PW Audio Supply, and the amount is $3,800. Now for Souk Stereo, they're going to record this as an increase or a debit in their inventory and a credit or an increase to their accounts payable account. So the inventory, we're going to increase it, and since it's an asset account, it's going to be debited. Accounts payable or our financial obligations, our liabilities is also going to increase, and since it's a liability account, it's going to be credited with the amount of 3,800. A little bit about the terms of sale and different terms of sale, beginning with freight costs. Now, freight or shipping costs, we have two terms that could be used for a specific sale transaction. Now, for the first, we call this a FOB shipping point or free on board or freight on board shipping point. And in this case, the seller places the goods free on board the carrier or the truck or the uh, boat or whatever carrying method is used, and the buyer pays the freight costs. Now, in this case, the ownership passes to the buyer at the seller's location. So by the time the seller provides the inventory or the goods and hands them over to the delivery method or to the entity that is going to ship or deliver those products, this is when the ownership passes to the buyer. This is in the case of an FOB shipping point. FOB destination, on the other hand, the seller places the goods free on board to the buyer's place of business, and the seller pays the freight costs or the shipping expenses. And the ownership only passes to the buyer by the time he gives or hands the inventory to the buyer at his location. Now, why is this important, or why does this make a difference? It makes a difference because there's a lot of incidents and things that could wrong during the delivery of the products, and this is to this designation is used to illustrate two things. The first thing is who is responsible for the products while they are in cargo or in the shipping process, and who pays for the um, delivery expenses. So in the first case, in the FOB shipping point, the buyer is the one who pays for the freight costs. And in the second case, or the second designation, the FOB destination, the seller or the supplier is the one who's going to pay for the freight costs. Okay, and the freight costs incurred by the seller are an operating expense. So keep that in mind also. This is going to be helpful for our recording procedure. Now let's take back this information we just learned to our previous example. Here we're going to have two scenarios. The first scenario is that we're going to assume that upon delivery of the goods on May 6th, Souk Stereo pays Acme Freight Company $150 for freight charges, and the entry on Souk Stereo book in that case is going to be inventory to cash. So here in this scenario, we are assuming that the transaction or the term of sale is FOB shipping point, and the customer in this case, or the buyer in this case, which is Souk Stereos, is going to be paying for the shipping expenses. Now, in that case, as you can see, they are recording this freight charges or the freight expenses as part of the cost of their inventory. So they're not recording it as an expense, they're just recording it as a part of the value of the asset or the inventory that they have purchased. And the other scenario, if we assume that the freight terms on the invoice in the illustration 5-5 in our previous example had required PW Audio Supply, which is the supplier in our case, to pay the freight charges. So basically, the terms of sale in this case is FOB destination. In that case, the entry by PW audio supply would have been freight out to cash. Freight out, of course, being an expense account. So they're gonna increase their expenses for the shipping and decrease their cash account. When you go shopping and buy some, let's say, clothes, there's always a possibility that you're not happy with some of your purchases, and you may decide to return some of them or exchange some of them, right? The same thing applies between companies. So the purchaser may be dissatisfied with their purchase due to either the goods are being damaged or defective, or uh, uh, inferior quality, or they do not meet the specifications that we ordered. Let's say we ordered a specific 100 pieces of a specific product in a particular size, and we got a different size or a different color or something like that. And now in that case, we have two scenarios that might occur. The first one is called a purchase return, where the goods are returned to the supplier for credit if the sale was made on credit, of course, or for cash refund if the purchase was for cash. So basically, we as customers return the products to the supplier, and we get our money back for that amount of products. The other scenario is called a purchase allowance, where the supplier may choose, or the customer may choose to keep the merchandise in case the seller will grant an allowance or deduction from the purchase price. So that especially occurs if the products are damaged or defective. The supplier might decide, okay, fine. So let's say 5% of the order is damaged, broken, or any other problem with it. The supplier might say, fine, you don't have to send these products back to us. You can keep them, but we're going to give you their amount of money as a deduction. So instead of charging you for 100 units, we're going to charge you for 95 units only. Just to illustrate a little bit further, as we mentioned before, in a perpetual inventory system, we record the cost of the products as a debit to our inventory in our general journal. Now this question here says, in a perpetual inventory system, a return of defective merchandise by a purchaser is recorded by crediting what? Since we've increased our inventory account, we debited our inventory account when we purchased those products. If we return some of them now, we also want to reduce our inventory account. So what we're going to do is we're going to credit inventory in our general journal. Another consideration that we need to look at is the event of getting a purchase discount from our suppliers. And that, of course, depends on the credit terms of the transaction. So the credit terms of the purchase transactions may permit the buyer to claim a cash discount for prompt payment usually. This, of course, provides a benefit to both the purchaser, in this case ourselves, and in that we're gonna save some money on our transaction. It could also provide a benefit to the, or an advantage to the seller, where it shortens their operating cycle because they can collect their money a little bit faster. An example of credit terms, as you can see here in front of you in the box, the terms may read 2/10 N30, and we read this as follows. We could say 210 net 30, and this basically means that the 2 at the beginning is the discount rate, so 2% discount, and then the 10/10 means 10 days. This is the discount allowance period, so you get a 2% discount if you pay within 10 days. And then the N30, or as I mentioned, is read net 30, means that you need to pay the full amount within 30 days. So you, as a purchaser, would have a choice between settling the payment within 10 days and getting a 2% discount on your purchase. Otherwise, you're going to need to pay the full amount within 30 days. On this slide, you can see a few examples of different credit terms. The first one is identical to the one we just covered in the previous slide, so 2, 10, and 30, basically meaning that you get a 2% discount if paid within 10 days. Otherwise, the net amount due within 30 days. The second one is 110 EOM. This basically means that 1% discount you're going to be earned or um, um, given to the purchaser if paid within the first 10 days of the next month. And the last one is N10 EOM. Basically, net amount is due within the first 10 days of the next month. We have seen before how we can record the inventory purchase transaction in our example with Souk Stereo. Now we're going to see how we can record the goods return or purchase return. So assume that on May 8th, Souk Stereo returned to PW Audio Supply goods costing $300. So this is, as you can see, is pretty easy. All we do is just reverse our transaction. So when we purchased the products, we debited inventory and credited accounts payable. All we're going to do now is we're going to debit accounts payable to reduce its balance and credit inventory to also reduce its balance for that specific amount of money that which is the value of the goods that we have returned. Here we're going to look at how we can record the payment or the settlement of previously purchased products. In this transaction, we assume Souk Stereo pays the balance due of 3,500. The gross invoice price, as you can remember, was 3,800. But since we have returned products worth $300 in the previous transaction from the previous slide, now we're only going to be paying for 3,800 minus 300, which is the amount of products that we have returned. The payment is going to be on May 14th, the last day of the discount period. Okay, so meaning that we, as accountants of Souk Stereo, we're going to account for a discount, a 2% discount. Now prepare the journal entry for Souk Stereo, or the Souk Stereo makes to record its May 14th payment. Of course, if you remember, when we pay or settle any accounts payable, we normally just record accounts payable to cash. Okay, so if we assume that we don't have a discount in this example, then the transaction would be accounts payable 3,500 debit and cash credit of 3,500. But since we are granted a discount and we are not going to pay the full 3,500, we need to also account for the discount amount. And the way we do that is that we multiply the amount due or the liability, which is the accounts payable, the 3,500, by 2%. In this case, it's going to give us $70. That $70 we're going to credit to our inventory. So basically, with this, we are reducing the costs of our inventory. So now our transaction with the discount is going to look just like you see in front of you. We're going to debit accounts payable 3,500, which is the full amount due, but we're going to credit cash only for 3,430, which is the amount due minus the discount, and the discount is going to be credited to the inventory account. Just as I have mentioned in the previous slide, if we assume that Souk Stereo failed to take the discount and instead made the full payment of 3,500 on June 3rd, meaning that they exceeded the discount allowance period, then the journal entry would be a simple entry, just like we were doing before in chapter 2, which is debiting accounts payable 3,500 and crediting cash with the full amount of 3,500. So no discount in this case. This slide here goes off on a tangent where it kind of tries to explain to you how you can make the decision whether to take a discount on a specific purchase transaction or not. And the decision here is going to be based on whether you are um, making better investment, or you could make a better investment of that discount amount if you delay your payment and not give the discount and only pay at the due date. So in our example here, we had a 2% discount on the 3,500, which represented $70. Now, the if we invest that 3,500 for the 20 days, so we don't pay it, we wait until the end of the allowed period, and we invest it for 20 days, assuming that we can get a return on our investment of 10%, which is quite optimistic in these days, we can get a return of $19.18. As you can see, this amount is way less than the $70 we saved by paying or taking the discount. Another way to do this is to decide how much is this 2% discount in a 20 days represent as an annual rate. And the way we can do this is we take the 2% and divide it by the 20 days and then multiply it by 365. So that will give us an interest rate on an investment of 36.5. And as you can see, this annualized rate is way higher than the 10% that we normally take into account as an opportunity cost or as a return on a specific investment. So if you can get a return higher than 36.5% on your investments, then it would be wise to not take the discount and just wait until the last day of the allowed period for payment and then settle the payment then. But as you can see, that is really not realistic. It's not easy to get a return on an investment of 36.5% on any investments really, except for due to luck. So normally, if we could assume a number more realistic, such as 7 to 10%, you can see that taking the discount in this case is actually the correct decision. Let us go back to all the information that we got in our example and look at how is that going to be reflected on the inventory account or the inventory ledger account. As you can see here, we have the purchase transaction represented on the 4th of the month when we agreed to pay 3,800 for the products we purchased. 2 days later, we also paid for the shipping expenses, so the freight in cost. We also record that as a debit to the inventory account. The amount here is 150. 2 days later, we returned some products worth $300, and we got a credit or reduction of the amount that we need to pay of 300. So we credit the inventory account for $300, and when we settled the payment, we also got a discount of $70. We credit that to the inventory. That makes the balance for the cost of our inventory of $3,580. Now we're going to take a look back to the same example we just covered, but this time we're going to take the supplier's side. So we're going to pretend that we are accountants for the supplying company, which is PW Audio Supply Inc. And we're going to learn how we can record sales of merchandise. The sales of merchandise can be made using cash or credit. They're normally recorded when earned, so usually when goods transfer from the seller to the buyer. And finally, the sales invoice should support each credit sale, just like we've done in the on the purchasing side. You have to have a source document for each transaction that you record always. Recording the sale of merchandise under the perpetual inventory system is a little bit interesting because we always record two entries. The first one is either we going to debit the cash or the accounts receivable account, depending on the type of transaction, whether it was cash or on account. And we're going to credit the sales revenue. So we're going to recognize the revenue achieved or generated by this transaction. Now for this first transaction, we're going to record the amounts under the selling price. So the amount of money we are charging our customers for that specific product. The second transaction is going to represent the costs. Remember in the when we talked about the perpetual inventory system and how we recognize the our inventory levels with every transaction of sale. So here we're going to debit cost of goods sold, and we're going to credit our inventory account. But for this second transaction, we're going to use the cost of the products that we sold. So assume that, for example, we are selling a, a computer device and we're selling that computer for 3,000, but we purchased it for 2,000. So in the first transaction, we're going to record cash to sales revenue of 3,000. And in the second transaction, we're going to record cost of goods sold to inventory, but for 2,000 only, which is the cost of the product that we are selling. So back to the first transaction, which is the sale transaction in this case, because we're looking at it from PW Audio Supply Inc.'s perspective. The transaction here says assume PW Audio Supply records its May 4th sale of 3,800 to Souk Stereo on account as follows, and assume the merchandise cost PW Audio Supply is 2,400. So applying that what we have just learned in the previous slide, here this is an on account transaction, so we're gonna debit accounts receivable with the sales price, which is 3,800, and we're gonna recognize the revenue that we generated by this sale. So we're gonna credit sales revenue for 3,800. We also need to record the other transaction we just looked at, which is the cost of goods sold. But for this transaction, if you notice, we're only using the cost amount. So how much this product that we just sold, how much did it cost us to acquire in the first place? So we're going to debit cost of goods sold and credit inventory, but this time we're going to use the 2,400, which is the cost of our merchandise. Now let's take a look at the sales returns and allowances from the perspective of the seller. So we looked at it from the purchasing perspective and how we can record it. We'll see now how is the seller is going to record any returns and allowances that he may grant to his customers. So this represents the flip side of purchase returns and allowances. And the sales returns and allowances is considered a contra revenue account. So it is a revenue account, however, its normal balance is debit, unlike the normal balance with a revenue account, which is credit, just like we've learned in chapter 2. Sales are not reduced or debited because they would obscure importance of sales returns and allowances as a percentage of sales, and they could distort comparisons between different financial periods and different companies. So that is why we don't just reduce the sales balance right away, and we use a revenue contra account, which is the sales returns and allowances account, just like we've done with the contra asset account. If you remember, the accumulated depreciation, which we said is an asset contra account, and it has a normal balance opposite to that is to that of the normal assets here. This is a similar situation, but this is for a contra revenue account. Now remember when Souk Stereo returned products worth $300? Now we're going to look at the same transaction, but from PW Audio Supply Inc.'s perspective, which is the seller's perspective. So the illustration here says prepare the entry PW Audio Supply would make to record the credits for returned goods that had a $300 selling price and assume a $140 cost. Now, we need this piece of information because we're not only going to reverse the sale transaction, we're also going to reverse the cost transaction. So assume the goods were not defective and we're just going to add them back to our inventory. Okay, so here we're going to record sales returns and allowances, which is the revenue contra account we talked about in the previous slide. Uh, this would take the revenues or the sales revenue account's place. And then we're going to also reduce or credit our accounts receivable, since we're not going to ask Souk Stereo to pay us 3,800 now. We're now going to ask them to pay 3,500 only. So we're going to reduce our accounts receivable by $300. On the other hand, we need to also increase our inventory levels since we are getting our products back. So we're going to debit inventory $140 and we're going to credit the cost of goods sold, which we have debited in the sale transaction, if you remember. But this time we're going to only credit it for $140, which is the cost of the products that were actually returned to us. Here we have a relatively similar scenario, but this time we are going to assume that the products that were returned to us are actually defective. So here the illustration says assume the returned goods were defective and had a scrap value of $50, meaning that even though that they are defective, we can still uh, get $50 for them or sell them for $50. So now PW Audio would make the following entry, same as we've done before regarding the first transaction, and nothing is going to change there. We're going to debit sales returns and allowances for $300, and we're going to credit our accounts receivable for $300 also. However, for the other transaction, instead of using the total cost of those products, which is the 140, we're only going to use the scrap value amount, which is $50. So we're going to debit inventory for $50 and credit cost of goods sold $50. Quick review question. The cost of goods sold is determined and recorded each time a sale occurs under periodic inventory system only, under perpetual inventory system only, both a periodic and perpetual inventory system, or neither a periodic nor perpetual inventory system. And of course, the answer here is B, under the perpetual inventory system only. Now we're going to talk about sales discount account. This is another contra revenue account. So just as the sales returns and allowances, this account is designed to counter sales revenue account. So we don't have to debit the sales revenue account directly. We use those two accounts to counter the revenue or the sales revenue accounts. So as you can notice, they both have a debit balance opposite to the sales revenue credit normal balance. Of course, the discounts are offered to the customers to promote prompt payment, as we mentioned before, because our goal as a merchandising company is always to try and get our customers to pay their money or the money they owe us as soon as possible. Uh, this represents the flip side of purchase discount, as we mentioned before. And as you can see in the illustration down below, taking the sales revenue balance and subtracting the sales returns and allowances and the sales discounts from it will give us the net sales. In our example here, the net sale is 3,430. How did we get that amount? We took the 3,800 minus 300 and minus 70. Going back to our example, in this illustration, we're going to assume that Souk Stereo pays the balance due of 3,500, which is basically the 3,800 minus the 300 worth of products that they have returned. And they're going to pay the amount to us on May 14th. So based on that information, we also know that they're going to get a discount. Here also in the transaction, it's telling you that this is the last day of the discount period. Now prepare the journal entry PW Audio Supply makes to record the receipt uh, of that money on May 14th. So here we're just going to record cash. Okay, we're going to debit the cash account for the amount that is owed, or the amount, the account receivable, but we're going to subtract the discount from it. So we're going to record, we're going to debit cash 3,430. We're also going to debit the sales discount account for the difference, which is the 70%, which represents 2% of the 3,500, and we're going to credit accounts receivable to close it for the total, which is the $3,500. And here we're going to talk about completing the accounting cycle. And as you remember, to complete the accounting cycle, we also need to make adjusting entries. Now, the adjusting entries for the merchandising company are generally the same as service companies, but one additional adjustment that we need to make um, to make the records, our accounting records, actually agree with reality, or with the actual inventory that we have on stock. And this involves adjusting the inventory levels and the cost of goods sold on our records. To do this here, we're going to suppose that PW Audio Supply has an unadjusted balance of 40,500 in merchandise inventory through a physical count. So they made a stock count, and then PW Audio determines that its actual merchandise inventory at the year end is 40,500, meaning that the actual amount of goods that they have is $500 less than what they have on their records. So the company would make an adjusting entry as follows. They're going to debit cost of goods sold 500 and reduce their inventory level by 500, so they're going to credit inventory 500 as well. Finally, when it comes to closing entries, when we want to close our income summary or close our accounting cycle, we're going to need to do a few entries. First, we're going to close income statement accounts with credit balances. And of course, here we only have one account, which is the sales revenue. So we're going to debit sales revenue and credit income summary. And then we're going to close income statement accounts with debit balances. So here we have multiple accounts, all of the cost of goods sold, sales returns and allowances, sales discounts, which is, these are the two contra revenue accounts, and also all of our other expense accounts. So we debit income summary and credit all of these expenses. And the difference between the total of income statement items with credit balances and the income statement items with debit balances is going to go to the owner's capital. So we're going to debit income summary and credit owner's capital account, and the amount, as you can see, is the difference from the previous slide. And finally, the owner's capital is going to be debited for the amount that the owner actually had thrown within that specific financial period. So in our example here, we have a $15,000 owner's drawings. We're going to credit that and debit owner's capital for the same amount. Here we're going to talk briefly about the different kinds of income statements. We have multiple step income statement and a single step income statement, and the main difference between the two is that the multiple step income statement shows several steps in determining the net income. So it would include two steps that relate to the principal operating activities, which should also show a step that relates or discloses the expenses that only relate to the sales activity. So it distinguishes between operating and non-operating activities, so it creates a different classification or different steps in the income statements. Here is an example of a multiple step income statement, and this is how it's typically presented. So as you can see, this is for PW Audio Supply Income Incorporation, the company that we were talking about in our previous example. It begins, of course, with the sales revenue, but as a classification, but as you can see, we have some details within the sales revenue because we also need to include the revenue contra accounts that we discussed earlier. So the sales returns and allowances and the sales discounts, we need to account for those. And once we subtract those two amounts from the sales revenue, we get what is called net sales. Now, net sales minus the cost of goods sold is going to give us the gross margin or the gross profit. Now, that gross profit can be divided by the net sales and it will give us the gross margin. And of course, after that, you can see the other step is the step that includes the operating expenses. So here we have a list of all the other expenses that relate to our normal operation. And finally, subtracting those expenses from the gross profit is going to give us the total or the net income for the financial period. So here you see how we can calculate the gross margin or the gross profit rate. So basically we're going to take the gross profit, which we have calculated in our multiple step income statement, and divide it by the net sales. And the net sales, of course, as I mentioned, is calculated by the sales revenue minus sales returns and allowances and minus the sales discounts. And that is going to give us the gross profit rate. The next key item is going to be our operating expenses, as I have mentioned before. So once we get to the gross profit figure, which is in this case 144,000, then we can go ahead and include our next step, which is to list our operating expenses. In this case, the company's operating expenses include salaries and wages expense, utilities expense, advertising expense, depreciation expense, freight out, and insurance expense. We take the total of these operating expenses, we subtract it from the gross profits. This operation is going to give us the income from operations. Now, if the company does not have any other revenues and other expenses, we're going to end the income statement here and we're going to call this last figure the net income. But in the case of PW Audio Supply, they do have other sources of income and other expenses, as we're going to see in the following slide. So here the last key item is the non-operating activities. As you can see, PW has some income from operations and other revenues and gains. These include interest revenue and gain on disposal of plant assets totaling 3,600. So we add those to the income from operating activities, and then we subtract other expenses and losses. Here we have interest expense and casualty loss from vandalism, and these two items totaling 2,000. So we're gonna take the subtotal here, which is 3,600 minus 2,000, 1,600, and we're gonna add this number to the income from operating activities, which is finally gonna give us the net income figure, in this case $31,600. The other revenues and gains and the other expenses and losses, which is the two broad categories of non-operating activities, are quite broad, but they normally include interest revenue, dividend revenue, rent revenue, and gains from the sales of property, plant, and equipment. So that is for the revenues and gains, or other revenues and gains. And the other expenses and losses most commonly include interest expense, casualty losses, and loss from the sales sale or abandonment of property, plant, and equipment, PPE, and loss from strikes by employees and suppliers. Quick review question says the multiple step income statement for a merchandiser shows each of the following features except a gross profit, B, cost of goods sold, C, a sales revenue section, or D, investing activities section. And of course, the answer here is D, investing activities section. Now on the single step income statement, unlike the multiple step income statement, we just subtract the total expenses from the total revenues. And there are two main reasons why a company might use the single step format instead of the multiple step format. The main reason is that the format is simpler and easier to read, and the statement is easier to construct. The second reason is that a company normally does not realize any profits until total revenues exceed total expenses. Those are the two main reasons why any company might decide to go for a single step income statement instead of a multiple step income statement. Now, if we go back to the same example we covered earlier for PW Audio Supply Inc., if we look at their income statements represented in a single step format, you're going to see that the revenues are all compiled together at the top under the revenues section, including the net sales, interest revenue, and gain on disposal of plant assets. These three items here give us the total revenues, which are in this case $463,600. And then you have the expenses section where you have all of the expenses also compiled together, giving us the total expenses. We subtract the total expenses from the total revenues and we come to the net income figure, which is the same number, of course, we got in the previous income statement of $31,600. And finally, representing our balance sheet for a merchandising company, we are only interested here in the inventory, which is going to be reported in the balance sheet. We're going to take the ending balance for the inventory or the closing balance for the inventory account, and we're going to report that under the current assets if we are using a classified balance sheet where we break down the assets into current assets and non-current assets, or current assets and fixed assets, or sometimes they're called property, plant, and equipment. The inventory is going to fall in this case under the current assets since it's considered a liquid asset that can be transformed into cash within 1 year or less. At the end, that's it for chapter 5. I'd like to thank you all for joining me for this lecture, and I hope you guys have enjoyed it, and I wish you a great day.